All right, we're live. Welcome to the first week of the Accredited Canadians Toolkit Real Estate Mastermind. And we're going to call it the ACT Mastermind because we're going to focus on the actions that you have to take to become a real estate millionaire. So let's dive into it. Let's see. All right. So we're here to talk about real estate. I firmly believe through all my research that real estate is the most accessible path for wealth for most people. And, it's a common statement, 90% of millionaires made it with real estate. And yeah, my name's Sam Perrin. That's kind of where I made my money. Before I dive into it, I just want to give a shout out to Chris Moffat, who I met through a mutual friend, Rich. And I got to say, I'm really impressed with Chris. He's this is him right here, right there, and right here. I don't know if you can see my cursor there, but he's sitting beside me. And Chris has achieved a lot as a young man. He leads a group that I'm part of, and men really bond shoulder to shoulder. And I've really enjoyed Chris's meetups like this one, which was the Valor Immersion project in July. And it's one of the things that I'm really proud of accomplishing this year is hanging out with these guys and getting beat up by real Navy SEALs in San Diego. So, when I something else about Chris I want to share. When I heard his a cappella rendition of Sean James's song "Through the Valley," it brought me chills, and I'm sure Chris's version is much better than the original. So even though we don't agree on everything, I'm privileged to interact with Chris and his brotherhood on a regular basis because iron sharpens iron. Okay, before I dive into the content, I just want to say that nothing I share is legal, accounting, or investing advice. So please consult with your qualified professionals before taking any actions that I talk about. Quickly about me, why should I be leading this group? Well, I was a police officer for 9 years, and during that time, I bought and managed about 20 rental units. And I retired from policing after 9 years. I was 30 years old then, 10 years ago. That was shortly after I adopted my kids. And in the course of growing my real estate portfolio, I published podcasts, I wrote articles. I was included in a couple of books, including this one, which was a Canadian bestseller. And this is a photo of me here beside my truck when I was in uniform as part of the Royal Canadian Mounted Police. And you can see my truck there is branded, investkamloops.com, because that was my brand, trying to attract investment capital to my projects in Kamloops. And I led a group called the Real Estate Network Training Society, RENTS. And at one of the events, I had over 100 people there, and it generated a lot of interest and activity and buzz. And by leading that group is how I built my real estate business. So I'll just play a quick video here to prove that, yes,
Kamloops RCMP have arrested a 29-year-old man after reports he pulled a gun on a woman in Riverside Park. The 55-year-old woman was jogging in the park when a man pointed.
There we go. Got too many tabs open here. Okay, there's the disclaimer. There's the best-selling book, and here's the...
Kamloops RCMP have arrested a 29-year-old man after reports he pulled a gun on a woman in Riverside Park. The 55-year-old woman was jogging in the park when a man pointed what appeared to be a handgun at her. The woman ran to her car and called police, and an officer tracked the suspect down.
So there I am, chasing down
on the beach along the South Thompson
guy
River
with the toy gun
near the Overlander Bridge. The officer pulled his gun and ordered the man to put down the weapon.
He is a
Kamloops RCMP.
Okay, so that's that. Here's my real estate track record. So presently, I do about $2.5 million a year in rental income. These are the doors I transacted. There's over 300 there, but presently I got about 180 units, residential units that I'm managing. I got 7 staff, roughly 7 full-time equivalent positions, and we do the management and the renovations for the portfolio. So that's that. So let's talk about why real estate. And to start, I want to talk about inflation. Do you know the difference between a 1967 and a 1968 Canadian quarter? Well, if you think about a quarter back in 1967, you could buy a loaf of bread. For 25 cents these days, maybe you can buy a gumball if you can find a gumball machine that does that. Or maybe if you're lucky, you can rent a shopping cart if they haven't upgraded the grocery store hasn't upgraded their shopping carts. But in my town, it's a loonie now to rent a shopping cart. So you basically can't get anything for 25 cents. But the funny thing is if you take a 1967 quarter, which is made out of silver, and you melt it down and you sell the raw silver, that raw silver you can still use to buy a loaf of bread. It's worth $2 or $3. So that's the difference. I use this as an example to illustrate the difference between the intrinsic value of something, of the metal of that silver quarter, and the value of fiat money. So 25 cents is worth almost nothing today, but you could have a meal with it in 1967, and that's because of inflation. So inflation is structural to our society, and that's not going to change in our lifetimes. People who control the money supply are known as, also known as the government. They have a monopoly on violence, and we all have to comply with their system. And what that system does through inflation is it's a theft. They're stealing our wages and they're stealing our savings through inflation. And it's publicly stated, in every country what their inflation target is. In Canada, our inflation target is 2 to 3% a year, which is slow enough to prevent political unrest, but real inflation that we're dealing with is a lot higher than that. So inflation is measured using a basket of goods. They manipulate that basket of goods and do substitutions. So if steak becomes too expensive, then they'll use hot dogs or ground beef or maybe dog food or cat food, or maybe they'll say you can get the same protein from bugs. So you can eat bugs, and it's the same price as steak was last year. So inflation is actually only 2%, where in reality we're all experiencing inflation upwards of could be 20% for some things, but basically inflation is here. Inflation is here to stay, and the only way to combat it is to own things that have intrinsic value. So if you know Rich Dad, Poor Dad, it's a very popular book. Savers and wage earners are losers, and you can read Robert Kiyosaki's book and learn about his cash flow quadrant to see where you might want to be. So how does real estate? I'm just gonna make sure that I'm on the right tab here. Savers and wage earners are losers. So how does real estate increase in value? So this is a graph that I got from a group that I was part of called the Real Estate Investment Network, the RAIN graph. And this is basically how you can predict where property values in your market are going. So everything starts with GDP growth, and then after that you have job growth. And with the increase in jobs, you got people moving there. That makes population growth. It takes about 12 months to get there. When you have population growth, you have increased rental demand, decreased vacancies, that pushes up rents. It takes about 18 months to get there. And when rents go up, there's more demand to people want to own more properties, investors or just homeowners, and that creates an increase in prices because with the law of supply and demand. So, and that's when builders will jump in, and you'll see housing starts go up, and that's when prices prices will lift. So you got supply and demand acting in tandem with inflation, but it all stems from GDP growth and population growth, which is super important, and I'll talk about later. So this is another model to predict real estate values, and this model comes from Harvard. So you can see here's the market cycle quadrants that Harvard has come up with. So you've got expansion, recovery, hypersupply, and recession, and you can look at your market to see where the market's going, and take some measurements that way to try and predict. And I'll go over how to do that. So I'll talk about this more during the question and answer. I didn't have it ready, but I'll have it ready during the question and answer later today when I'm talking to everybody. But it basically talks about it's an interesting slide. It talks about leverage. So if you buy a house for $1, and dollars in Canada are loonies, and you've got 2 to 3% inflation, then you're making 2 or 3% a year. But if you split your dollar up into 4 quarters, let's say as down payments for 4 different houses, then you've got 25% down, 75% mortgage. So with 4 houses going up at 2 or 3%, well, now you're not making 2 or 3% a year on inflation. You're making 4 times that. So you'd be making, 8% or 12%. So adding a little bit of debt, with a mortgage, and in the example that I'm talking about here is 75% loan, 25% down. You get to quadruple your return on your money thanks to inflation. But you can do, if you did it with 50% down and 50% mortgage, well, now you're doubling it, right? So if inflation is 2% or 3% or 5%, well, now you're making 4% on your money, or just thanks to inflation. And of course, there's other ways to make money in real estate. You can force appreciation by fixing a property up. You can increase the rents in commercial buildings to increase the value of that building, and I'll talk a little bit about that next. So there's a book called The Secrets of the Canadian Real Estate Cycle, and this goes into a lot more detail about how you can figure out if your target market that you're working in is in the recovery phase, the boom phase, or it's going to be entering the slump phase. And you just look at all these factors, and you can see that from the news and from various data sources that I can go to in detail, but this is just an overview. But those include demographic factors, financial factors, and emotional factors. And you can do this for your market. I did it for mine. We saw property prices double when I first started 10 years ago. I had a nice run up in property values because, and it just so happened that the market that I was in the beginning of the boom phase, and we enjoyed the doublings of prices thanks to that. So really quickly, I'm going to talk about this formula here, which is building value equals not net operating income divided by cap rate. This is how I'm making money in real estate right now, and it's a play on the bond market. So you look at the prevailing capitalization rate in your market, and in my market, for example, it's 6 or it's 5 or 6%, depending what part of town you're in. And you look at your net operating income. So your gross rents, just back of the napkin numbers, would be the total amount of rent that you're collecting in, and then you got to subtract out all of your expenses. So you're going to subtract out, and this is not just rents, but you've got storage space you can rent, you've got maybe some parking revenue, some laundry revenue, and so you basically take all the income, you subtract out your vacancy rate of say 3% or whatever it is in your market, and then you subtract all of your expenses. And a well-running portfolio of apartment buildings should be around 40% of the gross income should be going to maintenance and expenses. So so in my example, 2.5 million, 2.5 million. I'm just going to do it here while we're talking. I'm going to multiply that by 0.6. So that gives me a net income of 1.5 million. You divide that by the 6% cap rate, so divided by 0.06. And my portfolio of those buildings should be worth around $25 million based on a 6% cap rate. So the way to make money in this business is if you can increase the net operating income by increasing the rents, adding more services for your tenants, then because of the way the math works, you can increase the building value by quite a bit and increase the lending value. So let's use the example on one unit. Let's say we got a $10,000 renovation, and that's going to increase the rents on that unit by, say, $500 a month. So you spend the $10,000, you've got an extra $500 a month. So you multiply that by 12 months. You've got $6,000 increase in your net operating income. You divide that by your cap rate. So I used 6%. So I've got $100,000 of extra building value. Now I can go to a lender on that one unit and say, hey, my income is up by $100,000. I would like 50% loan to value on this new income. And they'll say, yeah, you can service that, no problem. So we'll give you $50,000. So you borrow the $50,000 from the bank, pay yourself back the $10,000, and now you've got an extra $40,000. And that's one unit. So if you scale this, if you can access commercial financing by getting into multifamily, and you can do commercial financing for other asset classes as well. There's a lot of guys on this call that own some retail, light industrial, basically any commercial financing. This is how it works. So if your inputs are less than the amount you can get on the refinance, you've got yourself a good business model. So none of this works without population, and an inflationary population pyramid looks like this, where you've got more young people than you do older people. So this is an old slide, but you can see Canada's population pyramid is not looking like a pyramid. There's a big bulge there, and our birth rate's actually very low. So the only way that we're able to continue with an inflationary environment here, where there's more people having more demand in that younger demographic, is by doing immigration. And we did a lot of immigration, especially after COVID. And we got a lot of people coming in. And what that does is it can disrupt the way a society is if people aren't integrating with the way that the culture is. And that can create some civil unrest and some problems if you're bringing in the wrong type of people into your country. And that's ideally, you're investing in an area for stability, and you're going to want to have people having babies of their own, because then they're going to be integrated into the culture a lot better. So these are some old slides talking about how there's going to be more people with funds, able to invest in things, as we're getting older. But you don't want to end up in a place where people are moving out of it, because if nobody's going to be living in the real estate in a particular town or region, then blight is going to set in. All you got to do is look at places like Detroit, and there's lots of examples of mining towns that all the real estate has gone to zero because the mine shuts down, and now there's nobody there. So if you're living in an area that doesn't have really great demographics, then you might want to look elsewhere. So you want to make sure that you're investing with inflation. If you follow Peter Zion, he's very bullish on the U.S.-Mexican border. You can look at the U.S.'s population pyramid here compared to Mexico's, and this is where there's some real growth opportunity because the U.S. looks like it has a much better population pyramid than Canada. So this is really an interesting guide by Joel Skousen, and he talks about he ranks different areas as far as how safe they are in the event of like a catastrophe. And he talks about are there military sites nearby that an enemy might want to throw a nuke at? Is there access to clean drinking water and lots of food to grow your own or to go hunting? Is there risk of earthquakes? Is there risk of any other big natural disasters, tsunamis or hurricanes, tornadoes, basically anything that could destroy your life? And he makes a guide. And actually, southwestern Canada, where I live, scores fairly high at 4.5 points. And he says it's that the region that I live in the Thompson Okanagan, he says it's like a composite of the terrain from Washington State to the plains of Colorado, all compressed into a much smaller area. It's a wonderful area for living and has our highest rating for Canada. In fact, it would rate a full 5 stars if it weren't for Canada's draconian gun prohibitions. So I wholeheartedly agree. I'm very grateful to live here and to have my business here, but it is certainly doesn't have all the freedoms that some of the states have, which make them very attractive for investing in places that I'm actively looking at potentially for a future deal. So just briefly, I want to talk about half real estate and half businesses versus ELF businesses. So half businesses are hard, aggravating, lame, and I forget what the F stands for, but frustrating, we could say. And depending on what business you try and get into within real estate, and there's lots to choose from, which I'll get into future weeks. You could be subject to licensing requirements. Like if you're going to try and be a property manager, you can't do that for other people without being properly licensed. If you're trying to raise money for a fund, well, now you're stepping on the toes of the licensed investment advisors, and there's regulatory bodies that'll ban you from various activities. So you got to try and find the area where there's exemptions. And if you're under the thumb of a regulatory body, it might be required for your business, and it's not a bad thing to be to be accountable to somebody to make sure that you're not running a scam. But it can really try and restrict what you're doing in your business. So because all these different aspects of real estate are hard, there's a high barrier to entry. So if this is something you want to do to make money for yourself and potentially for your investors, if that's the direction you're going to go, one of the benefits that you have is not everybody can do this, because there are regulatory requirements in place. But it's going to require a lot of education and work on your part to either get licensed or to work within the exemptions. And being a property manager, even if you are licensed, it's a tough job, because you're caught between tenants who are mad at you because maybe the building's fallen apart, and owners who are mad at you because they don't want to spend any money on renovating the building. And if you're in the renovation business, you're dealing with, in Canada, GST, collection, remittance, payroll, human capital. People don't show up to work on time. You got to be dealing with, disciplining them and hiring and firing. And if the work is shoddy, now you're on the hook. You've got taxes and different filings. The worst is customers who don't pay your own bills. that you can be subject to litigation. There's liability. I've been sued for snow removal and all kinds of things. So what you want to do is get into real estate, but not as a half business. What you want to do is get into it as an ELF business. So easy, lucrative, and fun. So I've developed some rules for myself to make sure that I'm always running an ELF business. And I've strayed away from this, so I'm going to be doing some restructuring. But some of the lessons that I learned that I would recommend for anybody getting into this business is you only work for equity, never hourly. So the way to do that is to collect director fees. You can collect acquisition and disposition fees when a building transacts. If you're going to provide services and vertically integrate to try and find some efficiencies, or maybe you're investing in a town or a city that doesn't have good property managers and you have to do that yourself. I know a lot of operators that have had to do that. Go ahead and provide services, but only for your own properties, because then you'll never get stiffed for a bill. And you can actually, if you're running an active company, you can flow some of that passive income that's taxed at the highest rates into active income for a more favorable tax rate. And you can also use your corporate structures, family trusts and stuff, which I'll get into detail in future weeks to limit your liability. And when you're raising money, you want to use the prospectus or offering memorandum here in Canada. You want to use the exemptions to raise money. So there's something that's relatively new that's come out called crowdfunding, where you can advertise to the general population and they can invest as little as $1. And there's crowdfunding platforms that do that. Or you sell your investment units or your shares of your investments to accredited investors. And that's what we're all trying to become. Being here is an accredited investor, because it gives you autonomy over your life. So next week, we're going to talk about where you are right now and your real estate business plan. I'll give you some resources to develop those. So I hope you enjoyed this little presentation. It went longer than I wanted, so I'll try and make it more succinct next time. And that's it for now. Have a great day. Peace.